Cool. So today I kind of wanted to walk through a just big Q&A list, right? So we have a ton of conversations and we get, a lot of the same questions over and over again. And we figured it'd be really helpful to go break down each of these questions. If you're listening here too, feel free to throw, more questions into the chat here as well. But we can dive into it. And, we've kind of thought about these questions in a few different categories, right? Some are more focused directly on, our deal structure and how it is that we operate. And some I'd say are more focused on just, general paving, general roll-up strategy stuff as well too, in terms of like how it is that we think about it. So we can kick it off. I think first we're going to dive into the sourcing piece of companies too, right? So first question we have here is how do you source acquisitions? Is it proprietary deal flow or broker relationships? And I'd say this is a combination of both those areas, right? We do use brokers on our end. We have done things like cold calling. I think what you'll find here too is that a lot of these sellers are all friends, right? It's a pretty small space where if you take, anyone listening to this call now as well too, your friends are likely fairly similar to yourself and kind of who your connections are fairly similar to yourself too. So on our end, what we've seen is that the owners of companies we acquire to date have a lot of connections to other companies and their friends own similar companies as well too. And then Chris, if you want to cover what's in your acquisition pipeline for the next year and kind of how are you thinking about what fits best in the portfolio?
Yeah, so just one comment on the how do you find acquisitions is you just have to put in the work. Like, you have to do whatever you think you need to do. You need to times it by 10 and talk to as many people as possible. Talk to all the brokers, investment bankers. We talk to CPAs, we talk to attorneys, we talk to people in positions of trust. But the amount of effort that it takes to generate a good deal, I think is oftentimes understated. But in terms of our acquisition pipeline, we have a lot of really exciting acquisitions that are on the horizon. We're talking to, at any given time, we're talking to between 5 and 7 different companies, all kind of going through and making sure that they're going to be the good fit for us. We usually don't go more than 2 companies under contract at the same time, just to make sure we can give all of the kind of attention to getting the company closed. But we have a great pipeline right now. One of the underlying economic dynamics that is pushing that for us is that, according to the Asphalt Pavement Association, 27% of its members cite succession planning as their number one business problem that they need to solve. And so we're really seeing that. And when we talk to people, it's, the kids don't want the business, and, the owner wants to retire. So we think that kind of underlying market dynamic has created a lot of deal flow for us.
Cool. And then Chris, do you want to cover more so the acquisition criteria, right? In terms of size, EBITDA, geography, I think revenue makeup and kind of where it's coming from as well would be helpful here too. And obviously understanding that these are more like general rules of thumb, right? There are obviously exceptions on either side of it. But if you had to think of the kind of buy box criteria that you're looking at, what does that look like mostly?
So I think the number one thing when we look at an acquisition is we take like a principles first approach. Like the numbers, the data, all of those things are important, and we look at that. But at the end of the day, we want to buy a great company. Right. And so, what does a great company look like? We want to buy a company that has great leaders in it, that people that we can develop. We want a company that hasn't hit its prime yet and is plateauing off. We want a company that still can continue to grow and still has some room to expand within the market. And so when we're looking at the company, and that's really our initial assessment is this a company that we can take and grow? Is this a company that is going to fit within our portfolio? Is this a good company? Is this a company that we want to own? Like, we don't buy anything just to buy it. It's like, do we want to own it? And is it going to add value to our platform of companies? And, and then from there, we do look at certain kind of revenue and EBITDA metrics. I really don't like buying companies under $5 million of EBITDA. The world is just harder when you're below 5 million of EBITDA. We really like to see at least 15 to 20 million in revenue. And the reason why is there's kind of these life cycles that companies go through. And when you break, the 15 million in revenue and, probably over about 4 million of EBITDA, the world kind of changes with what you're able to do with the company. And, they're kind of at the bottom of the next level. So if you look at like kind of like a small business you're looking at a business that's doing like 0 to 5 million in revenue, and anywhere from 500,000 to maybe 2.5 million of EBITDA. Like that kind of dynamic is they're at the top of kind of their class, if you will. And then the companies that survive and can get market acceptance and continue to grow, those companies kind of break through that next phase and they get into that 10 and 15 million dollar range, and then 15 and 20. And what we have found is that there's a lot of things that happen to go from 5 million of revenue to 10 million of revenue that create a much more stable company. And it's even better from 10 million to 20 million. Really what it tells us is that in order to support $20 million of revenue, you can't have everything rely on one person. And so what we see in small companies is when we go out and we look at a company only doing 3 or 4 million in revenue, usually those companies, not all the time, but usually they're almost 100% reliant on the owner, which creates a really big key man risk. And so we go a little bit bigger, and that helps us mitigate that.
Yeah, really good points. And then when you kind of look at the diligence team, right? Like, what does that look like? Like, what process, who's involved, what role does each person play, and kind of what are their backgrounds on this side of it as well, too?
Yeah, so our due diligence team is broken up, a lot like like almost like a football team where everybody has their different, positions of what they do and kind of where they block and where they tackle. And so on our team, we have our M&A team comprises probably 7 or 8 people who all have different specialties. We have people that are experts in financial modeling and are experts in doing the quantitative analysis of companies. We have people that are really great at integrating the companies together and being able to see how company A is going to integrate with company B, what processes we need to eliminate, those types of things. We have experts in equipment and what the field operations are doing. So they'll go in and sit with the field ops team and really look at that. They'll walk the projects, make sure they're good there. And then we have accounting, finance specialists that go in and analyze how they're doing. So we break the company down into every category or every kind of department and part of the company. And then we bring an expert from our team to manage that facet of the due diligence. And then where I sit is I kind of make sure it all comes together. And then with our investment committee, we then look at the totality of the company based on all of the different specialized people who put their input in on the due diligence. And really, it's just an iterative process where, to be honest, we're looking to say no. And so if it can survive 6 or 8 rounds of that, then we'll say yes and we'll do the deal.
And so what are some big things that have killed the deal that look good in those first handful of rounds? Then once that you get to one of the later rounds too, that's killed the deal. Like what are some of those things that have caused the team itself to say, this deal is not for us?
Yeah. So we looked at a company not too long ago where their financials looked really, really good. They were a bigger company. Financials looked great. They had a really mature management team. That all looked great. And then we sent our team out to go and do to walk their job sites and to inspect their equipment. We actually brought in somebody who's an expert on government contracts, which was where they were deriving a lot of their revenue from. And he came in and he did an analysis on what contracts they were winning. And really what we uncovered in that is that when you actually pulled the hood off is that they were really profitable. But when you looked at what they were going to be doing based on the equipment condition, and then also based on the jobs that they were being awarded and what they were winning and what they were bidding on, as we dug deeper, we found deep problems with their estimating department. They were unable to accurately and profitably bid work. We found issues with their equipment and their maintenance, where a lot of their equipment wasn't in good working order. And then we did we brought in an expert to do the backlog analysis. And when they analyzed the backlog, they found that most of the projects that this company had won were from 2 years ago. And so we said, what happened between now and 2 years ago that changed that? And we were able to uncover some changes in leadership that happened during that time that really changed how the company was operating. So on its face, it looked great. We were really excited. We kind of started peeling back the layers of the onion and we did that. And just for context, that process took 21 days. Right, about 3 weeks to just go through and get to that point.
Yeah, and a follow-up here too to that point is that, a lot of people ask to, hey, this seller's built this company for the last 10, 20, 30 years, and they put the infrastructure themselves. how does it usually work with a seller who may be actually getting ready to go retire? I know we've had scenarios in which the sellers choose to go stay on and they're part of the team and they, keep going forward. But in the scenario in which they'd step back, how do you think about the risk that ties to it in these scenarios too?
I think a lot of it, kind of going back to the earlier comment, depends on the size of the company, right? If you have a company that's doing 50 million in revenue and, the CEO is more of a cheerleader, the founder's a cheerleader and is involved, but really isn't that involved, then we look at that as like a lower risk situation. If we look at a company that's maybe a little bit smaller, maybe doing 10 million in revenue, but is really profitable, we will really analyze what that owner wants to do. In fact, we had a company in northern Florida that we underwrote, and they were so profitable. It was insane. They were like doing 15 million of top line and like 9 million of EBITDA. It was a crazy company, and the owner was just like, "Hey, I want to just completely peace out. I don't want anything to do going forward. Like, I've made my money, I'm done." And so then as we started digging into it, we started to realize that the owner had very strategic relationships with a couple customers that created all of that extra profit. That certainly, as he went out the door, that profit was going with him. And so, like a deal like that, we decided to pass on.
Yeah, that makes a lot of sense too, where they can definitely prop it up, right, from their connections, from them doing the work too, and not actually counting their time as well, right, in terms of going back to the bottom line. So those are always things to look for as well. I think when you actually look at, some of these scenarios that we're buying companies, there's no competition, right? It's an off-market deal. You're the only one talking to them. But in scenarios that are, say, marketed deals, or especially as paving itself becomes hotter and hotter, right? How do you think we differentiate ourselves versus other sellers other buyers who may be willing to go pay a higher price?
I think that being in the industry, and actually operating, and being operational in the industry helps a lot. I'll tell you an example is we were in a competitive process with one of the companies that we now own, and they had received numerous LOIs. I mean, from everybody that you can imagine, all the biggest players. They were getting a really great valuation. And, when I sat down the first time with them, they said, we can turn our bids in under 24 hours. And that just blew my mind because having been operating with these companies in the industry, none of our companies currently could bid anywhere near that fast. Like turning a bid that fast was just something that we weren't able to do. And so I said, that's crazy. Like, you got to show me how you guys are doing that. And I immediately picked up on that. And the comment that was made after was, they said that to every buyer, and we were the only ones who thought it was impressive because all the other buyers lacked the context of what actually goes into putting out a paving bid. And it just created this common language and this resonance. And that's how you build rapport, is if you're speaking the same language and you come from the same, angle, and you can see things in the business and you can relate to that, and you're not asking these questions that are totally out of context. It creates the foundation that you can build a lot of trust on. And I really think that if I were to look at like the breakdown of why companies tend to want to sell to us, I think that's a lot of it, is that we get the industry, we understand the industry, we're operating in the industry, and we really, really, we're very good at being able to praise what a company is doing well, and then being able to provide solutions for areas that aren't going well. And I think that provides a lot of value to the seller and builds the confidence that when we take over the company, we're going to be able to continue to push it forward.
Yeah, I think that's a big thing too, is right. If you look at a lot of these bigger private equity firms, they have experience in private equity, right? Raising money, working investors, scaling that sense. But there may be that gap in the actual industry experience that they're buying in. I think a big thing that differentiates us is that if you look at the skill set that both Jeff and Jeffrey and the whole nationwide team have today, is that they built that entire platform. Most people in the space are going in and acquiring a platform, hoping that top talent stays on, give them that level of infrastructure, right? We built that internally with folks who have 30 plus years of paving experience. So when you go to market to go acquire a business, to go work with a seller, right, that you built it yourself, that goes a really long way. That's a family-run business, right? Both, Jeff's son, Jeffrey, and his daughter, Rachel, are in the business too, and they're really crucial parts of the company. I think they see that, hey, you have the kids working here, you built it yourself, the likelihood that this isn't going to run smoothly going forward, and that you'll take care of my employees going forward too, I think that creates a massive differentiator for us as well too. And when you look at, structuring a deal, right? How do you think about the deal structure itself between cash, equity, debt, seller carry, seller earnouts, right? How do you think about each of those areas when kind of putting a deal together that makes sense for both, us as a company to go buy them, but also as the seller to go find a win for them too?
So the number one thing that I look at when we do a deal is how do we reduce our risk, right? In those worst case scenarios, how do we reduce our risk to, as little as possible? And how do I structure the deal in a way where the incentives are aligned to keep people motivated? So when I look at deal structure a lot of times as like guardrails on the highway. Is that there's a lot you can do in between those guardrails, but ultimately the guardrails are there to keep you from going off the road. And so when we look at seller carry, when we look at some of these other things, my number one goal is to create an incentive for that person to continue to do what's in the best interest of the company. And so if you give somebody a whole bunch of money up front and they're not that motivated to stay around, then you need to create an incentive structure that motivates them to stay around because you need their help. In order for it to be successful. And so, when we look at seller carry, we want it to be real painful for them to walk away. We want them to lose sleep over walking away from their seller carry. And when things get hard, because in business things get hard, where we acquire these companies, a lot of times change is very disruptive to the business, and it creates a lot more work and a lot more managing relationships, and you have to really spend the time managing the relationships, and that creates like hard conversations, more work. And so when you have a seller who's like, wait a minute, I just got a life-changing amount of money, I'm ready to go right off in the sunset. Oh, hey, and all my employees who were cool with me before the sale now all hate me because I sold the company, and they feel like I betrayed them in a way. We don't want that person to just be able to say, hey, it's easier for me to just walk away and not deal with any of this. We want to keep them motivated and incentivized to help us kind of stabilize the ship post acquisition. And so our deals primarily consist of some sort of seller carry. We usually tie performance based on it. So if they come in and they stay on for a year or for 2 years and they help crush it, we're going to be giving them some of the upside for their continued work. We don't love earnouts. I feel like an earnout is just waiting for an argument. Earnouts tend to be really complex. And there's a lot of different ways that you can create ambiguity with an earnout. And so what we've done is we've really just pushed for like more simple, straightforward deals where it's like, hey, this is how much money you're going to get to close. This is how much money we need you to leave in the deal for this amount of time. We'll pay you some interest on the money. But simple, especially in this industry, like simple is better. Simple is better.
And so what are some of those levers too that you've added in there where, for a seller to both achieve the seller carry, but also gets the upside too? Like what are certain things they have to go hit?
Yeah. So what we like to do, and this is more of an industry specific thing, we like to do it to the net free cash flow of the company. So if they increase net free cash flow of the company, meaning, we have more money, distributable funds to our investors, then we're going to pay them a portion anywhere between 10 and 20% of whatever that increase is. So our kind of viewpoint on this is, hey, we're going to pay you for your business, right? We're going to pay you for what your business is doing today. And let's say that number's $10 million, and you're doing, call it $4 million of EBITDA. We're going to buy your business today for 10 million. You're going to get that 10 million, and then we're going to get $4 million of EBITDA. Well, if you take that 4 million after you've already sold the company and you take it to 6 million or 7 million because of your connections and what you're doing and you working on the business, you should share in some of that upside. And we think that that's a great thing for us because, we can move quicker, and the seller is going to know the business better than anybody else. And so we view it as a huge resource to move forward. And then if the seller can make, some additional money, and sometimes, you think about it, it could be $1 million if you did it right, it becomes meaningful for the seller to stay engaged. And it's not just staying engaged because I have to get my seller carry. It's staying engaged because not only can I get my seller carry, I might be able to get some more on top of that.
And that's also on top of an actual salary too.
On top of a salary as well. Yep.
Yep.
And we're usually like pretty fair with salaries with the sellers, to be honest. Like, we probably need to look at that in the future, but we understand the value that seller brings to the business. And so we're willing to actually pay a little bit more in a salary or pay a little bit more to the seller to keep them, motivated and on board. Because when a seller checks out, in this industry, your people are everything, and your people can know when their former owner was dialed in versus when he's not, or when she's not. And so, we really try to structure our deals in a way that the seller wants to continue to be with the company for 12 to 24 months.
Cool. And now let's cover some of the post-acquisition type playbook as well too. So what are a couple things that change operationally once we take over that the previous owner may have not done the most efficient way, or there's room for improvement in there, or it's a new process? Like, what are like a few of the quick wins that are put in place right away when looking at the takeover?
The biggest one is the accounting function. A lot of these people just don't do their accounting right. And that's a good point in due diligence as well, is like when you're underwriting a company in due diligence, you need to have a multifaceted approach, because a lot of times the numbers are accurate to the seller, but they're not actually accurate in terms of like GAAP compliance or how you really should be doing the accounting. There's costs that should be capitalized to the balance sheet that show up in cost of goods sold. There's all of these different things because a lot of these sellers aren't sophisticated on the finance function. And so, I think the biggest and the quickest win that we can go in and do is we can implement our financial framework, our technology stack, and take the financial component completely off the hands of the seller. And every seller we've worked with has loved that idea, because all of them hate doing the financial component of the business. They just want to go lay more asphalt. And so that's a way that we can, we usually start with the finance function, because one, that's a very important function to us. We need to make sure we control the money. But number two, it gives us the ability to, provide some value to the seller of saying, hey, let's take this off your plate. And then also, it allows the seller to be more focused on the people-centric portions of the business, like operations.
Cool. Yeah, I like it. And then I think this is a good one too. I know one of the first things that Jeff did when he came in was on the traffic control, right? Bringing in house. Do you want to walk through just what that looks like and apply some numbers to it too, right? I think this is a really good example in where a really simple, small change, if you play it out and look at actual enterprise value and control that was added from one small thing, how meaningful that is to the actual company itself.
Yeah. So on the traffic control, Jeff says this, Jeff says this all the time, where it's like, if you walk into your house every single day and you have a brick on the bottom of your, side of your house that's cracked, after seeing it for 5 years, kind of don't really notice it anymore. And so a lot of these owners have just been running their businesses for so long that they don't notice some of these areas that they can create efficiencies, because honestly, a lot of them are comfortable. They're making more money than they ever thought they would make. Things are running smooth. So like, don't rock the boat, if things are running smooth. And change is more headache to a lot of them, even if it's good change. So, we noticed at one of our companies, we were spending a lot on traffic control. We were spending about $5,000 to $5,500 a day per job to have traffic control on site. We said, hey, can we get 2 of our own traffic control crews, get them in there, and what can we reduce that cost to? And so we were able to reduce that cost to, I believe, just under $2,000. And so we saved on that job, essentially $3,000 a day. And it's those types of little changes that you can make, of just saying, hey, like, let's just do it this way, and we're going to make a little bit more money. If you just do that enough times, you can create really meaningful uplift. A lot of these companies are fairly bloated. They have a lot of inefficiency. They're working, which is great, but you can tighten some things up just because you're a fresh set of eyes. And and honestly, a great source for this is employees. Like, if you sit down, every time we buy a company, we sit down and we start talking to people. And if you just ask them, like, hey, how could we do this more efficiently? All of a sudden, then you'll get this influx of just all these ideas of, hey, we do it this way. This makes my job 3 times harder. I have to do 5 times more work. If we were to do it this other way, it would streamline it and we'd save like 2 days on this. You're just like, well, let's do it that way then. As long as it's going to produce the result, let's make the change and do it that way. And it's a way that we can empower the employees. If we come in from, a leadership perspective and say, these are the changes we're making, right? We have to go then get the buy-in of the employees, right? We have to sell the vision to really get them bought in. The employees are coming up with the ideas, and they're the ones closest to the business anyway. They're coming up with us to the ideas, and we're listening to those ideas, and then we're making them happen from an implementation front. It builds a lot of trust and respect.
Yeah, it's super important. This is a really good one too, right? In terms of quoting. So we do work all throughout the United States, and our teams from Nationwide travel 30 plus weeks a year. But if you're a big corporation, right, we do a lot of Fortune 100, 500, 1000 type work. And for them, urgency is a really big thing. So if you have to go think about it, right, what is a really big competitive advantage that we have? You want to break down what that looks like in terms of how quickly we can go both quote and execute on jobs as well.
Yeah, so one of the things that we do that's differently on our commercial and our maintenance side is we have a very strong sales function. And so we don't backlog work like 6 and 8 months out. Most paving companies, they want a really big backlog so they don't have to think about selling. But on our side, we're a very sales centric organization, and we have a national sales team, we have a local sales team, we have salespeople in different geographies, and they're always kind of just beating the drum for more work. And what we have found is that we can increase our profit margin if we can get there faster than anybody else, right? So we tell them, everybody, we're not going to be the cheapest by any means, but hey, we're going to get there, we're going to get the job done, and we're going to show up, and it's going to be done in like the next week or two, not in the next 2 or 3 months. And what we've seen is the market is extremely responsive to that, and they really like it, and they're willing to pay more for speed. And so everything that we do on our side is how can we get to the job site faster? How can we use technology to optimize our route planning so that we can be more efficient in getting the work done faster? And so, we usually don't keep more than a 4 to 6 week backlog.
And so kind of pivoting on that too, right? And that's more so in the private sector, right? We also do a lot of government work as well too. Helps understand kind of the difference in, process around that, margin around that, and kind of how we think about the portfolio itself as a makeup between both public work and private work.
Yeah, so that's a great question. So public work and private work are a little bit different animals, right? They're almost like different companies, if you will. And we think the best is to have a blend of the two, because we think that creates a really stable platform. But when you look at the government side, the whole goal of the government side is backlog work, right? Backlog as much work as possible, because the way that they bid government work is low cost, low bid. So it means whoever bids the cheapest is going to win the job, hands down. And so you always want to be bidding a lot, because you may not win work for 4 or 5 months just because that's how the cards fell for you. And so having a backlog on that side is really important. And so on our companies, we like to have more than $20 million in our backlog at all times. We feel really good when it's like around 35, 40 million. Just because, and that puts us out, a little less than a year, just because it gives us really great visibility and insight over what we're going to be doing for the next little bit. And the advantage of the public work is that they pay you we get paid on the 10th and the 12th of every single month for the work that we did the previous month. And so it creates this really predictable kind of cash flow cycle. They pay you what's called a mobilization fee to get your guys out there so that the project cash flows from day one. And so, that's what the public side does. On the commercial side, the downside to the commercial side is our clients, we have great clients, but a lot of them just won't pay us for 90 days to 120 days. I actually was just on a payables call, and we haven't been paid for some work we did in June of last year. And we're like, what's going on with this? And, those big companies, they will always pay, but sometimes, something will fall through the cracks, or it'll take a minute to pay you. And that's okay. It's just, you have to really manage your cash and your working capital. And so when you have those two things together, where on the commercial side, you have a lot higher margin, but a lot slower, kind of cash conversion cycle, where on the public side, you have very low margins, you're talking 10, 12, 14%, sometimes as low as 7, but it's so consistent and you're always going to get paid. And you're never going to have to chase your accounts receivable because the government just pays you on their schedule, and it's pretty easy. So we feel putting both those things together, you kind of get the best of both worlds, where you can have consistent recurring cash flow with a client that is going to pay and is good for it. And then, but a little bit lower margin, but then you mix in the commercial margin with that, and, you can create a really stable, kind of cash position in a company.
Cool. And let's switch gears a bit now too, as well, to go cover more of the structure for investors and kind of why we look to go create things around this way. So, on our end, right, what are the return metrics, hold time, and then why do you choose this structure? So I can kind of walk through the structure itself, right? So we elected to go more of a preferred equity structure. And the reason is that if you look at how the capital stack is structured, right, first you have your senior debt, then you have preferred equity that's paid out, and then all the common and residual value of the companies itself is behind that. And the reason we were able to go do this structure is we wanted to go solve for a few key things, right? Number one, we had the big benefit that both Jeff and Jeffrey contributed their entire company to the actual platform itself. So that gave us a significant amount of buffer room when looking at the common equity value. Second, we wanted to help provide a liquidity structure for investors, right? Myself, I'm in, I think, 100-ish, give or take, private investments at this point. And what you'll find is that these investments can be really good, but you're getting, hit in the sense that you don't have liquidity. So part of what we wanted to go create was a vehicle that we can go consistently bring in capital to go scale, but also had structured off-ramps for investors to go provide themselves liquidity because, people's time horizons are different, right? Life happens. We wanted to make it really tangible and predictable as to how capital gets out of the deal for investors, as we found that was a huge pain point for other types of private deals. It also allowed us to go put investors in a higher position in the stack too, where, we view this in our end, and again, do your own homework and research as well too, but we view this in our end is that this is more of a, mezz debt, right? Or kind of preferred equity like risk with more equity type returns in our end. So our goal is how can we go create a structure that is a win-win, right? How can we go put investors behind the capital stack, give them really good, predictable type returns where we still own the common equity behind it, which has a lot of our money, time. I think Jeff put in $4 million to go build Nationwide himself too, with his son Jeffrey. So all the sweat equity they have there as well as behind it. But more importantly, it gives investors a really strong position as it relates to the collateral tied to it. And this is a structure as well too. Like we can go hold this company for decades and go pass it down to our kids too. So it allows us kind of that right of doing so with predictable ways to go give liquidity to investors, but more importantly, have the right to go hang on to this for a very long time and not be a forced seller because we have a funded timeline we have to go abide by. So it does, liquidity, strong returns in our opinion, very, very aligned in terms of who gets paid and when. Basically what we're doing in ours, we're kind of pushing our compensation as the owners of the company itself to the back end to allow for a priority payments to investors. So, with that point in mind, our goal here is to pay really strong, comparable cash flow the first few years, right? A called 8% target, and then have that option after year 2 to get, bought out. I think a big thing here too, Chris, we can cover is at that 2-year mark, like where does that money come from on the buyouts? I think we want to cut, it's 4 main areas. I'll let you touch on each of them after too. One, it would be debt, right? In terms of getting additional leverage, and Chris can go cover how that, mechanically would actually work. 2, it would come from, cash flow from operations, right? There will likely be additional cash flow from operations that we use to either buy net EBITDA or we use to go pay investor capital back down. 3, how we structure it today too is that all of our capital coming in tomorrow likely has a lower target return than capital coming in today, right? Or 4, there's the opportunity to go sell off, parts of the common equity in the future to allow for liquidity to go pay back investors or take chips off the table in the future as well too. But Chris, why don't you cover kind of how the debt mechanic would work if we use more leverage to go, pay investors down after a period of time?
Yes, I think, this structure didn't just materialize from just because, like Sam and I were talking, right? We had talked to different lenders and different banks as we were trying to figure out the best structure and really what the bank likes about this deal from the 2 banks that we've talked to is that they view acquisition financing as incredibly risky because of the integration period. And so they're okay to lever 3 and 4x on an acquisition. They just feel like there's a lot of risk in that. And so when we talked to them about this preferred equity structure, they really liked it because it allowed us to get a company integrated and then essentially refinance out the pref equity investors after it's stabilized. And the bank felt like that was a much better credit profile for what like a bank wants to do. And they felt like they could have lower leverage on the portfolio in doing it that way than if they were to just give us acquisition financing at 2 or 3 times to go and purchase the company. And so while we will use a mixture of acquisition financing and pref equity to buy companies, I think and this goes back to what we were talking about, deal structure, is anytime you're doing a deal with a bank, anytime you're doing a deal with an investor or whatever, it's all about incentives, right? Like what are the incentives? And so when we look at what the banks are willing to do on this, the bank's incentive is to reduce risk as much as possible and to loan as little money as possible for, to be able to meet the need. And that's really what a bank does. And so in this structure, we've, incentivized the bank to take out investors because it lowers their risk profile than if they were to do just the acquisition financing. And so, that's how we think about it. And ultimately, when we go into these companies, and even if you look at the total leverage on our portfolio right now, we're not really all that levered for the size of company we are. And so as we, go to different banks and capital providers, and start to push that leverage, it because of the strategy that we're doing of actually buying the EBITDA with the money that we're raising, then it creates kind of this stair stepper effect where it's like you can buy net new EBITDA that lowers the leverage of the portfolio overall. You can integrate it, and then the bank is willing to do a little bit more. So I don't know if that answered your question though, Sam.
Yeah, it's also helpful too if you look at even just the yield part of our investor returns at call it 8%, right? The first couple of years, that's actually higher on a dollar amount than it would be from bank financing. What we're seeing right now as we get to a place of scale, once we close our next acquisition here in the next 4 to 8 weeks, we expect to be over $20 million of debt across the portfolio once we refinance the entire thing. And what that allows you to go do is that allows you to go work with much higher quality lending partners that in turn can give you rates that are SOFR plus say 250 to 300 from what we've seen so far from our shopping. And SOFR right now is in the mid to high threes. So you're looking at, your debt starts with a 6, right? Most likely in that scenario. Maybe some variance to it, but you have potentially a lot better debt you can get across the portfolio because you've entered that size now and predictability scale for the bank where they can underwrite your whole portfolio as a business and feel a lot more confident in that structure too. So I think this is a big thing here too, right? Where in a lot of private deals, when looking at kind of the total return, you need to have some kind of meaningful exit, right? To go, hit the numbers to investors. On our, if you kind of play out those numbers too, we actually really don't need an exit to go pay investors back on that 2 or the 5 year period. It can really be done just through leverage. So when you kind of play the numbers on here too, like, if you want to walk through the, a target company we have in our pipeline right now and just the numbers tied to it of what that actually looks like. So for example, we have a company that's in our pipeline that's say, an $18 million acquisition, right? We'll probably bring, $7 million of equity to it, bring, probably $7-8 million of debt, and then some more seller carry tied to it as well too. So you kind of play it out in the future, right? It's really, attainable to get all of that out without actually increasing EBITDA in terms of the investor equity behind, ahead of the seller carry. So it's like really tangible to go, get 3x leverage across the board to go do that. And Chris, why don't you take this one too? What if you can't refinance, right? What if there's a window of time in which we have capital due on the 2-year buyout and, 2 or the 5 year buyout and investors want their money back and they want to move on? What happens if there's not cash available to go refinance at the time?
So if we're unable to meet the agreed upon timeline, what we have what's called a liquidation class. And so the investors drop into that liquidation class where they capture 100% of the excess cash flows from the company to pay them back. And so really, that's I think that's one of the things when we talk about deal structure and aligning incentives, we're very motivated to get the investors paid back, because if we don't get them paid back, then all of the cash and, the cash flow from the company goes to paying them back. So it would, in turn reduce what, our compensation would be, which if we can't pay it back, rightfully so, but it creates that aligned incentive for us to go and do it because we can't get paid until the investors get paid. And so that liquidation class is kind of a catch-all of like, hey, if we can't do it, then you're going to get paid back from the cash flows. And I think the other real thing is that it would be a likely scenario is that we would just sell a portion of equity to cover, the buyout if there was some sort of deficiency.
Yeah, that's the nice thing too about kind of controlling the common equity internally across the 4 partners is that, you have the right to go sell that common equity to minority owners who can go give liquidity to the company, go pay back investors if that's needed. Cool. And before we wrap up here as well, what are a few more good ones? So this is a good one too on the return profile, right? Of like these returns are pretty attractive overall, right? Kind of why are you offering such high numbers out of the gate if you view the risk profile to be what it is today?
That's a great question. Is, from our perspective, we're highly motivated to pay a little bit more now so we can own more of the company later. And I think that if we look at it, internally, as we've talked about, like what can we pay, what does the math support, and all that, and that's these are the numbers that we came to. But really, the motivation comes from being willing to pay a little bit more to be able to hold the company, to not dilute ourselves and hold more of the company over time.
Yeah, basically it's okay, us saying we're okay taking the back seat in terms of the order in which we're paid to allow ourselves kind of hold the company long term. Also, we really feel as though we have a unique window the next few years to go acquire companies before the pricing companies gets out of hand. I think this is a good topic too. Like if you look back to, HVAC a handful of years ago, you saw companies trading at 3x for $1 million to $5 million EBITDA companies. And now that's probably, I don't have math in front of me, probably 6, 7, 8 maybe, depending on the company itself.
I just saw an HVAC company at 2 of EBITDA trading for almost 7.
Yeah, so you're seeing stuff like that, right? So what that shows you is that same dollar of EBITDA, once something gets hot, is worth way more because you have more people going after it, right? So we feel as though we're in the early stages right now of paving, which we can go acquire at really attractive basis, where we think that will change longer term. So on our end, we think we can go benefit from both the market shift of paving coming in more demand and the expansion as it relates to us getting some more scale as a platform. As in this space, the bigger you are, the more integrated you are, the larger multiple that you trade for. So for example, a company that's doing $100 million of EBITDA will trade at a better multiple than a company doing $5 million of EBITDA. So on our end, our goal is to go capture the benefits of the timing of both the market itself potentially heating up. We don't need it to happen, but our guess is that it may, and also capture the upside from the expansion of the multiples, growing as we grow as a company and scale too. So for us, right, we can go potentially have our cost of capital be a bit higher if we can go acquire more, because if your platform in the future is worth 10, you're acquiring at 4, you have substantial margin to go play with if integrated the right way into the full platform. Cool. Well, let's open it up to anyone on the call too. If you have questions, I know we covered a lot today here too. So if you have questions, throw them into the chat here as well. And we'll cover them here before we hop off. Okay, this is a good one too. So what's the public, comp when looking at this space too? So the big public company in this space is Construction Partners, Inc. They trade under the ticker ROAD, ROAD. And depending on the day, they do about $400 million of EBITDA when looking at their whole total portfolio. They trade anywhere between, 18 and 22x, depending on the day itself. They're public, so you can go kind of see it trade day to day, right? And that we think is really high, right? From the stance that our projection is not to go sell at 18. We think that's a long shot. And the reason they definitely get some extra turns is like, one, if you're a public company, you get extra turns in EBITDA because of liquidity. But if you're an owner of a public company, you can effectively go borrow against your shares and go take money out tax-free, right? To go borrow against, you don't have to actually pay the capital gain for that period of time. Additionally, there's just market liquidity to go trade. So you always get some extra juice because of that. They also own a lot of things like materials plants too. So we see that as a, really far side upside scenario, but we don't actually expect to get there if you don't go public, you don't go have certain things that they have as well too. Cool. Well, I think that's it for today too. So everyone, thanks for hopping on too. And we will see you all again next week. So thanks for joining. Thanks, Chris.
We'll see you guys. Thanks.
Bye.